Good morning, everybody. Thanks very much for joining us here. This is one of a series of events that we've been running across Europe. We were in Paris a couple of weeks ago. I was also in Delhi until yesterday, so I'll try and feed back a little bit on some of the things I picked up from there. And I'll also share with you some of the things that we picked up in Paris from the Outlook session there. For those who don't know me, my name is 𝗣𝗿cie. I'm the publisher at Real Asset Media. This is going to be the session this morning, so we're going to have a kind of brief presentation from Markus Cieleback at PATRIZIA.
So, giving you a little bit of an introduction to the panel discussion later on and a little bit of our views on what happened over the last 12, 18 months, because I still think starting with a little bit of a look back at what happened over the last 12, 18 months explains quite well what can we expect going forward, because I think looking at the last 1.5 years, this is possibly one of the dominating things everybody has been talking about, or the dynamic of interest rate rises we have seen over the last 18 months. And now the story is ever more about when will interest rate peak. I think we heard yesterday from the Fed that there is a high likelihood that we see declining interest rates next year. And there is discussions also in Europe that the ECB will start to lower interest rates at the latest in the second half of the year, and there are some forecasters that think as early as April we'll see the first interest rate declines. But one thing we should always remember is, being an economist and looking at the economic effects of interest rate rises, it takes you between 12 and 18 months until that interest rate rises will be felt in the real economy. So when we look at what happened over the last 18 months, we can be sure that this kind of interest rate dynamic will influence a lot what will happen in the next 6 to 12 months, because it will be the effects of that interest rate rises. No matter if the ECB starts lowering, let's say in April or May, there will still be effects of the rising interest rates coming to the real economy at that point in time. So that is one of the things that we should keep in mind when looking forward what will happen next year. I think one of the other things is, and that's possibly not the big surprise, it was very unexpected and unusual. We looked here a little bit at some kind of interest rate structure curves between December 20, December 21. You see that there is a little bit of a similarity between the gray and the red lines. And then you see the jump to the December 22 line. And that was, at the end, the challenge the market was confronted with. And it is the dynamic of the interest rate that is the challenge, because if we take a longer run perspective, interest rate levels are not that high. We are coming from a period of zero interest rates, and therefore these 400 basis point rise feels steep, and it is steep. But if you look at the overall interest rate level, it's still a level we've seen in the noughties of this century, and it's much lower than in the 1990s or even the 1980s. So we are not living in a high interest rate environment. We have seen a high dynamic of interest rates, and that is possibly the big challenge. And you can be a little bit cynical on that side. If you're older and in the industry for a little bit longer, you have witnessed interest rates on that level already before. But if you only entered the industry in the last 5, 8 years, it might be a high level of interest rates. But it's only if you have a short history in that point in time. And I think this is also influencing on how we think of the current environment and how people will think on how that will progress going forward. And the other thing is, and I've used that slide in different presentations. You see the turquoise dot on the bottom left, and what we see here is you have global stock returns, global bond returns on the x-axis. It's a total return index. On the y-axis, you have global bond returns as a total return, and you see how, let's say, special the year 22 has been. And I think when I talk to investors, I always tell them the year 22 was their year when they finally got what they wanted. They increased their real estate quota. Unfortunately, they increased it in a passive way because stocks and bonds declined in value. And that was still having a big impact on how they acted in 23. But if you look now at 23, the orange dot, it is not mitigating a lot on their high allocation to real estate. The only thing that is mitigating that we see valuation declines now trickling through to real estate as it's a lagging sector from an economic point of view. But what we should not expect going forward is that everything is fine from the allocation perspective and everybody will run into real estate and saying, I will have to invest and raise my quota again. Because the quota at the end of 22 will still be high. Because stocks did a quite okay job over that year, but bond investing is not really coming to the rescue saying real estate quotas will go down significantly. Yes, we have seen some capital value declines if we look at all these quarterly indices of MSCI, but it has not been that high, these value declines, that we can assume that real estate quotas are at a level institutional investors will run for real estate in large amounts. Nevertheless, if you look at this slide here, it also gives you an argument why real estate. Because if you look at a typical 60-40 portfolio and look at the correlations, a simple trend line tells you that it's possibly not the negative correlation you will like from a diversification perspective. So adding real estate in a portfolio still makes sense. Nevertheless, what the valuation and the yield levels might be, because it is one of the things you can diversify. If it's real estate or real assets might be discussed, but if you want to diversify, you need something else besides stocks and bonds in an overall portfolio. But one thing we should keep in mind, and that's when I talked about interest rate forecasts at the beginning. Being an economist, I can say this possibly. We have been great at forecasting the interest rate path over the past years. So trust every economist that is forecasting interest rates going forward. So this is possibly a reminder that how good we are at forecasting interest rates and what we should think about when we forecast and when we use interest rate forecasts. Nevertheless, and coming now back to more on the real estate side, the transaction volumes have been gone down across the board. But what is the consequence, what I just told you about investors and these kind of expectations for 24? We won't see a return of the years before the interest rate rises and the Ukraine war on transaction levels very soon. Because at that point in time, real estate was often marketed as an alternative to a government bond with stable income streams. And a lot of investors came into real estate simply to secure that stream. These investors will not return next year. They will not return the year after that quickly. So overall, you can be sure that transaction activity will pick up, but possibly nowhere close to the levels we have seen before, because simply some part of the investor base will not return that quickly to the market as they have other ways to secure their income stream with rising interest rates. And the other thing is, and I just have some data now here for the first half year, and if you look at the table of the right-hand side, I wanted to show you the top 10 deals in Germany, and I ended at the top 7, because the top 7 in the first half of the year already go down to 150 million. So you see that size matters again, but in a different way. The larger the deal, the more difficult it is really to find buyers in the current environment. It has to do with high interest rates. It has to do with leverage, with a different approach of banks. And also it has to do that many investors who traditionally came in, they don't want to do that 500 million, 800 million deal. So if we look forward and if we think about some of the activities that are in the market, deals below 100 million, I think we will see a strong activity returning. But where everything that goes beyond 100 million will be a little bit more challenging to find a buyer base. And there's another thing we should keep in mind at the end. Fundamentally, we are quite in a good position. And what I show you here is the office cycle of the top 7 German markets. And what we see is that was the period of the global financial crisis. You had high vacancy rates and you had very limited rental growth. On the rental growth side, we are a little better, but in a similar position. But from the vacancy side, we are quite in a solid position. So we are not entering a challenging market phase with, let's say, a lot of oversupply in the market. It's possibly quite the opposite. the good quality real estate many tenants are looking for is in short supply, and that's supporting a lot of prime rental levels in the office sector. If we look at, let's say, retail, the situation is possibly a little different. Retail came out of the pandemic where it already was undergoing structural change and strongly rising yields. Then the cost of living crisis hit and the market was again challenged. And now we are in a situation, there are some bright pockets for retail as well. If you look at daily need food retail, or if you look at things like outlet centers that have a clear focus, or even if you look at luxury retail. But generally, retail is still in a phase of structural change. And if you look at the inner cities in Germany and looking at what now with some of the challenges of Sigle coming to the market, that will impact the retail landscape heavily in the inner cities. Because no matter what you think about the company, these kind of flagship department stores in the inner cities, if they stay empty for a while, that will impact the footfall and the inner city fabric to a large extent. And that will, especially for the high street, be a big challenge going forward. On the food retail outlet center side, I'm quite optimistic on that this will, going forward, still attract a solid investor base. And ending possibly with a short look at residential. This is one of the slides I like very much, and a lot of people are in Germany obsessed about our German house prices. And if you look at the Bundesbank reports over the last 5 years, they continuously tell you they are 30% overvalued. The interesting thing is they are 30% overvalued for the last 5-8 years, and every year they tell you the price rises are irrational, which in itself is not quite logical, because how can the overvaluation stay roughly stable while we have irrational price increases? And now everybody's pointing to that decline and tells you now we have the proof that there was a bubble in the market. Hey, we had 400 basis point interest rate rises, and that should have an impact on house prices. Otherwise, why did the low interest rates had an impact on house prices in the past years? So that's not a proof that we had a bubble. And possibly there's another thing if you look at house prices. Being an economist, you'll learn in one of your first lessons that housing is a consumption good. If you look at what the Bundesbank is analyzing, it's analyzing price-rent ratios, it's analyzing price-income ratios. That's an investment good perspective. So how can you completely explain a consumption good price development from an investment good thinking? I'm not saying that price-income ratios don't matter. They matter a lot. How much mortgage you can, how large the mortgage is you get from a bank. But overall, we should be careful trying to analyze a consumption good on an investment good thinking. And that is possibly one of the big challenges when it comes to residential, that we have to more look at what do our tenants want, what do our buyers want, and what is their approach from a consumption good perspective, because this is what it is for many tenants. And ending up, I want to give you one of the things going forward is, where will real estate yields move for? And what I've shown you here is a little bit of the 30-year perspective on Germany. The gray shaded area is the 10-year government bond yield, and then you have different prime yields for different sectors. And I think the big story we have to remind us of here is this period here was a period of exceptional monetary policy by central banks. And why do we believe that this exceptional interest rate period revealed the correct bond yield gap? So what we should not expect that the real estate yields will continue rising until that bond yield gap has reappeared. Because it's much likely that as real estate is a lagging sector and it takes time until it reacts, yes, yields will go up, but they will not go up that much as we should expect if we simply look at government bond yields and their movements. And possibly the 1990s are also not the best say where we had that negative gap, and that's heavily driven to reunification in Germany. But if you look at the noughties of this century, the gap has been around 100, 150 basis points, and that's possibly what will return. And this means going forward, if we can factor in some possible interest rate declines later that year, at the end or in the second half of 2024, then there is much less of yield decompression to expect it in 24 than many people possibly might think. We might be closer to a stabilizing level on that side. That doesn't mean that quality of assets will not mean there is much more decompression in ESG non-compliant asset if you take one of these buzzwords. But there is definitely less to fear possibly than we might think on the first glance. This is maybe as a short intro and a starting point on what we will discuss later on. And now handing back to Richard with his short jet lag from India.
And also to say thanks very much to Philipp, Craig and the team here for hosting at CMS. Fantastic. And my view is we should really come back in the summer at some point and be able to use that, the great terrace out there. Let's just start off with some quick introductions, maybe starting with you, Markus. Is also to say thanks very much for those watching this on demand. Markus.
Okay. Yeah, it was already displayed. I'm with 𝗣𝗿cie, heading the International Investors Department in Origination for loans. I have a team of 8 people and be with the bank for 12 years now.
Super. Philipp.
Hi. Yes. Hello and welcome. My name is Philipp Schönnenbeck. I'm partner at CMS for real estate. I'm very pleased today to host the event together with Real Asset Media, and hope you enjoy the event.
Thank you. Good morning, Barbara Lewandowicz. I'm the founder of Molveno Investment Partners. It's a newly established company of mine, focusing on asset management, investment management, and portfolio transactions. I've been into real estate for the last 20 years, and I'm honored and pleasure. It's a great honor and pleasure to be here with you, not only because it's my birthday.
Yeah, happy birthday to you,
Happy birthday, Barbara. Definitely. Yeah, good morning. Also excited to be in a physical meeting again after all these virtual events we had in the past. My name is Thomas. I'm partner from PwC, located here in Frankfurt, leading the German real assets team, so crossovers, real estate and infrastructure, and also at least try to coordinate our global real estate activities at PwC. And I'm, by my DNA, I'm in real estate for almost 30 years, and I'm a deals person.
Great. And yeah, Markus, just maybe to introduce PATRIZIA a little bit.
Just introducing Markus Cieleback, Chief Urban Economist of PATRIZIA. We are an investment manager for real assets, I would say, and I'm, as you have already seen, the part of colors and slides when it comes to presenting stories about what we think about the markets and how we think cities and regions will develop going forward.
And on a sartorial note, it's always useful to see what socks Markus is wearing. The fried eggs are very good today. Good. Let's start with you, Markus, just in terms of, I guess, I suppose, any reactions to the presentation, but also, I guess, how do you see 2023 as we start to look in the rearview mirror a little bit, and what does that suggest to you for 2024?
Well, I can confirm what Markus said earlier. Well, I'm one of the oldest in the industry, over 30 years as well. I have seen the interest rates at 8 and 9%, and having a very young team at the moment, they only know levels at next to zero, to motivate them to accept the new challenge and the changing markets. That is a real thing at the moment, which we all have to deal with. 23. Yeah, was the impact, the lacking real estate always lags behind the real economy, and 24 will not be any different, I presume. We will see the knock-on effect, the LTV testing, all what comes through out of that scenario. We will see that throughout next year, and we will be very busy with the stock rather than with new transactions.
Okay, good. Might be interesting, Thomas, just to pick up from you. Because obviously there's the PwC ULI trends research. I guess, what are you seeing from that? Do you see 2024 as a sort of, year where it'll gradually improve and then 2025 is best, or what's your sense of it?
Yeah, we have this general sentiment of saying survive till 25 is one comment from at least the European report. But we have published all 3 regional reports, so Americas, Europe, and Asia Pac. And I think the general sentiment is that 24 will be a year of finding ourselves, hoping that we get on the bond yield side some more clarity where the central banks will move and how the long-term bond as a benchmark for real estate will work out. Hopefully, end of 24 will be a bit more positive. I don't think that 100 basis point will be enough, to be honest. That's a bit of hopefully, or I would hope, but I think it's a bit of wishful thinking. If you compare that with US gaps or gap premiums and in other parts of the world, 100 basis point looks a bit soft. So we will see a year where we have to react. We have to focus on our assets, on our legacy books, and I'm always laughing when I hear this discussion. Yeah, next year I will have the opportunity to invest. Yes, there will be opportunities if you find capital which is willing, but we are sitting on the legacy book we have to act on, and that's something back to the core competencies, looking at the efforts. I had some discussions before that now also some big fund managers are looking for people that are really, really focusing on the asset level, on the tenant level. What does a tenant want, not just in the resi space, but also that's something where we have to focus on. The ESG transformation is there, and it will come more and more regulation will coming up around the globe. We had now 2 weeks ago the Singapore taxonomy. Q1, Saudi Arabia will have a taxonomy coming up. So there's more regulation coming, which is good, moving in the right direction. But that's something where we have enough work to do without focusing on new deals, to be honest. There's so much transformation work we have to do. And we could talk about digitization, so much topics that we can focus and should focus on. Yeah.
Okay, good. Barbara, just it'd be interesting to get your reaction to that, because I think it's interesting, that longer-term perspective. So does that mean that, real estate's real asset side is going to have to kind of shift its view, move back to some of the things that it was doing previously? What's your sense of that?
Before I start exploring the sort of the outlook from my perspective for 2024, I would like to start with a metaphor of boiling a frog. So apparently, if you put a frog into a pot of hot and boiling water, it will jump out and eventually survive. But if you put the same frog into a cold water and then turn on the stove, it will eventually boil to death. And I think this is a fantastic analogy to what we've experienced with declining interest rates over the course of last 10 to 15, 12 years. I think the people and most of the investors didn't really detect the danger of declining interest rates. And that brings me to a first theme of my outlook, is that we're going to revisit and we are going to scrutinize our investment strategies, because I think the investment environment has changed dramatically. I mean, we've had declining rates for the couple of years. We haven't asked ourselves how long will it take. Then we had a rapid surge in interest rates. Everybody's asking, how long is it going to take to keep the interest rates? And I think there is a global belief that the interest rates are going to stay higher for longer, even though we will see 25 basis points there or somewhere else. However, the interest rates are going to stay in this range. It means that we're going to experience a shift in our investment environment, and I think that the investment strategies that we've experienced since 2008, that will really benefited us, will not yield going forward in the outcomes, in positive outcomes. So I think team number one is definitely, we're going to open our books and we're going to think about our asset allocation and capital allocation.
Okay, good. Philipp, I just wanted to pick up with you for a second. You're seeing a lot of the transactions coming through, obviously. And Markus pointed out there, that he couldn't go beyond the top 10 before it was lower than 150 million. So is there still deal activity? Is it just at a much lower level? What's the situation? What are you seeing coming across your desk?
Yes, I think it was declining by the end of 2022. We already saw that the transaction volume was declining. We still had transactions in 23 in the beginning, which were transactions started already, so they people tried to finalize the transaction. Although we noted that it was far more difficult to sign a transaction, so it took largely longer, so for months longer than normally. The speed was out of the transaction, so it was really like difficult. And what we can see clearly that there's a complete shift in the asset allocation of transactions. So I think I had one office transaction this year, which was signed successfully, and then the focus is very much on logistics, it's data center, is alternative, is energy, yeah, like solar projects. That is something which is really like going up tremendously, and so normal transaction volume has very much declined. But let's say we as a law firm, yeah, we have a full service approach. Yeah, we can advise our clients in any fields, and of course there's a lot of restructuring going on. Transactions are maybe done by joint venture structure, so all of that structuring and restructuring and refinancing is also done by us, and that is what we have seen in the market.
Okay, I'll pick up on some of those points in a minute. And I know you have to go fairly soon, Markus, but I just wanted to pick up with you. The session that we had in Paris, for example, was much more positive than I expected it to be. So the view there was that there wouldn't be much bleed through into the economy, that actually businesses were doing quite well. So from a macroeconomic perspective, things were good. Obviously, there's larger infrastructure projects going on there, Grand Paris, but also the Olympics coming. But for sure, they were seeing a lot of demand and people paying higher pricing, higher rents, and the policy in general seemed to be heading much more towards the ability to be able to, from a planning point of view, to be able to reposition things as residential if needed and those kinds of things. Are you doing any research, Markus, around what you're seeing here, particularly in the wider economy, and whether or not more companies are likely to be in stress as opposed to the real estate side?
Yeah, I think you can say we're in Germany here. We are possibly a little bit less optimistic, like the French on that side, to be polite on it. I think the political sphere and the thinking in Germany currently is not that positive in a sense that you can expect a lot going forward. I think also having a real estate perspective, I think that the cities are in a quite challenging environment currently, that it's the retailers that are challenged. It is some of this. We are now looking forward what will happen to gastronomy going forward when the VAT rise will start in January. So there are a lot of, let's say, special political activities or results of historical activities that will impact real estate in a way where we have no historical example on how that will actually impact. We have the positive side of that. Let's say wage growth is kicking in, and hopefully the trains are still running in January. So there at least there is some kind of activity that will support the spending side of households. Nevertheless, overall, I think there is it's a much more critical environment from the companies in Germany than compared to what you expect, what you presented for France. Maybe that has to do, we don't have Olympics next year in Germany anywhere.
And go ahead.
One comment to add. Also talking to a lot of, let's say, international investors focusing or could invest around the globe. What I hear is, yes, America is very dynamic, Asia-Pac very dynamic. Europe is in general more it's getting more and more complicated. Of course, with regulation, might be Green Deal, might be other topics, and then coming into Germany, I hear a lot of negative sentiment of saying, oh, we are not sure, the safe haven is not there anymore, lots of things are changing. Of course, it always comes with opportunities. Yeah? I don't want to be too negative, I think, but we are facing globally really feedback that we should do our homework. And I think that comes with the opportunity to wake up and say, look, we know what we have to do and position ourselves to be ready in, 2-3 years, that investors will really have a positive view on Germany again. It's not so negative, and some people say it's great to have all this international capital gone now. That gives us the opportunity to buy again. So you can see it from both sides, but in general, I think there are some homeworks on the energy security, but also from the foreign policy, always looking at what will happen in the US on the election next year. That will also have a significant impact. Also could have impact on the setup of our army, for example. If you look at the real estate portfolio of the German army, it's a really disaster. It's a 50 billion investment case. So, but again, the government woke up and said, look, we have to do something, and we are handling that. So but you can't change it from one year to the other. It takes some time. But that's a comment. So the general view on Germany is not as good. But having said that, it comes with opportunities.
Okay, good. And just from a PATRIZIA point of view, Markus, just on that sort of element of capital, international capital versus domestic capital, PATRIZIA are obviously investing in a lot of different regions and areas. So you mentioned real assets there. Are you also then looking more towards the sort of things that Philipp was talking about there as well, which is heading towards renewable energy and those kinds of things?
I think there is still a stronger view from many institutional players to infrastructure, given that you have a different type of income streams, longer, often inflation adjusted. So there is an argument for many. Nevertheless, if you look at real estate and the locations, there is also an argument for real estate as well. The only thing is that, given the allocations, I think many players are still reluctant to get in. The story is more about, I would say, the value add side of the market, which traditionally is possibly not the institutional German money that's focusing on. That's more the international side. So, and that's the challenge. How do you get the international money to, let's say, look at the opportunities in a country that possibly doesn't have the best image currently about the economic situation going forward? I think the opportunities are there. The only challenge will be really, are we fast enough to act on them? And possibly our German situation is not one of acting fast, and the German speed for LNG terminals is one that you don't find in many other areas.
Okay, I also wonder whether or not in Germany you actually see it much worse than necessarily everybody else does. But that's just maybe my take on it. Markus, it'd be good just to tackle the financing point. It would be rude having a bank on and not looking at that. So I guess, how do you see that, particularly in the context of some of the things that Markus was talking about there with the longer term interest rates and the adjustment to that? You were saying that you've been in seen these cycles before. So, but how open is the bank? How much of it is refinancing, or how much is it going to be used up by elements like funding transition and those kinds of things? So I guess, what's the situation like at the moment in terms of financing, and I guess where are the priorities for the bank?
Well, banks are maybe subject not only to serve the clients, but also very heavily regulated. And that came out of the last financial crisis, and all those regulations kick in right now more heavily than we wished for. And that limits also the capacity. So having a downturn in values means that your ratings under your loans will deteriorate, and you need to put more equity, and the equity ratio is very closely monitored also by the ECB, more risk-weighted assets under those loans, and those limiting the options which you can do new business for. On the other hand, there is not that many transactions out there. Even have seen those 7 there, 3 of them is with one company. That is more distressed than anything. You see, there's hardly any market in 2023, and it will continue there. So we can focus, and we would like to do more on the transition side. We have taxonomy-conform loans, we have transition loans, and products in place to support the transition of the economy and real estate. Having said that, there is an equity portion needed and an investor willing to spend that as well, and that is lacking at the moment. So we see that there was a big scene in 21, 22, ESG all over, and at the moment everybody's just making sure the impact is not as heavy, making sure they survive, and then look at these kind of concepts further. Having said, also where the office market is at the moment, that determines only the good offices, the ones who don't need the capex and the ESG investments, because that is the ones which rank way other ways, and that is the impact which is on the most of the books at the moment, and is the biggest concern which we will face looking forward.
Okay, good. And Philip, from
Maybe Richard, allow me one question to Markus. Yeah, just a second, because
you can have two if you want.
okay. I mean, looking at existing building, and we had some discussions on with clients when they say, "Yeah, look, my bank told me that there is like an equity gap, so they have to put equity in, but they say we cannot go to our investors asking for more equity." So, what's the bank going to do in that cases? Will we see more enforcement, or what's your plan on that? Will you be like waiving all the time the covenant breach?
It's a good one, and it is a clearly answer is depends. Yeah, every situation is different. Every loan is structured differently. Every client and investor base is different. We have those who said, well, the breach. Well, we don't want to be in breach. We are regulated. We are rated. We do not lose our rating. We rather pay down and use the funds there. We others who are fully invested don't have more capacity to do that. So we need to work out of a scenario out of the asset itself. That over time we come to a cure, meaning there will be no distributions, there will be money going into amortization, a word which was not existing in the last 10 years, which in the 90s was quite usual. Even at a high interest rate, there was always amortization in. So and that is a wide field of good and bad, of available capacity and not, and every situation, as I said, is different and needs to be worked out on a individual basis. We have daily calls on our deal teams and meetings saying it's a new situation, how we go forward, how do we employ our capacities, what is most important at the moment to really make sure that we are safe and that also we found a suitable solution together, because we cannot do that as a bank alone. And for closing a loan is the last thing a bank wants to do.
And Markus, do you think there's going to be, do you think there's going to be more of a role for given the regulatory issues, that the challenges that the bank has to deal with, do you think therefore that there's going to be more of a role for the debt funds coming in to support some of these areas, or where you would then be working with the debt funds? What's the situation there?
I mean, if the cash flow is not sufficient in an asset bought at a 4% yield, then that fund will not be able to provide a cheaper debt either. So we're playing in the same battlefield, and they're less regulated. They have maybe more flexibility in certain amounts, but nevertheless, the economics must stack up. Otherwise, they won't do that either. Working with them, it's a different approach. We're seeing a lot more money into debt funds going into whole loans rather and senior positions than pure mass. We're also seeing some players disappearing because their mess is completely wiped out at the moment. So also there is a wide range. And this morning just read there's a big funding gap of over 100. But it depends on what you figure in there. But the next 3 years there is a gap, and that needs to be bridged somehow. Whether it's private money, whether it's banking money extending, whether it's money coming out of cash flows. That is the most important thing. But we will also see some equity wiped out and some foreclosures that will really happen.
Yes. Okay. Barbara, you wanted to pick that up.
From the theoretical point of view, I mean, real estate debt is like the asset of the hour. It's actually the first time in a long time that the risk-reward profile is very attractive. The combination of falling valuations, then reluctance of banks to actually finance projects, and also the high nominal capital cost, offers a very good environment for alternative lenders. So there's some music there. I remember when I was still working for a family office a couple of years ago, there were fundraiser asking me for debt funds, and I asked myself, why should I actually give them money for debt funds when the money is actually lying on the street? Now the situation is different. On top, we're dealing with the funding gap. The research by AEW quoted 93 billion coming up next 3 years in 6 European countries. Out of it, 36 relates to Germany. So there is a lot of things to do, and I think this will keep us busy. So we'll see. The question is really what kind of products they're going to really tackle and work on. Whole loans for like 6 to 8% on average. Mezzanines, I mean, mezzanine funds have a very bad track record looking at the past, but now the quality of the mezz has changed. So there's a lot of opportunity there. So we'll see. I think the outlook 2024, so 2024 will give us many answers to that question.
Okay, Thomas,
the process is still ongoing.
Yeah, I can absolutely confirm. It's of course the mezz books, the legacy books are a disaster, more or less, because especially with the aggressive ones going up to LTV, old LTVs, 90 to 50, 95. But now margins are increased, LTVs are much lower, more conservative. But so I fully agree. But of course, we are now discussing this meta level. Where should be the corporate bond yield? Where should be the real estate yield in general? But then it comes down to the asset level. Which types of assets are really attractive? Yeah, and all I hear, the two big mega trends are really fundamentally driven. It's resi. It's in Germany, of course. It's a big disaster. It's too expensive to build, but the need is there. That's positive. Yeah, and the other one is still the broken supply chains and a big change around the globe on. Changing supply chains, coming with logistics, which was hype always the last 10 years, but there's still a fundamental need. If you look at rental markets, etc., these are the two big assets class where we still have a lot of potential to grow, even if it comes with challenges, construction costs. We know in resi it's a big topic, but these are the two trends I really hear. Office, yes, we all know, nobody wants it, but we have it. It's 40 to 50% of our allocation, so we have to handle it. And again, office is not office. Yeah, we heard the Class A, if you being in New York, it's the same. Class A office are doing okay-ish. I wouldn't say well. Rental markets and all this interest increase and value potential cap rate increases the last year were compensated by rent increases still. Yeah, that comes now to a still stand, but the Class A offices are still doing really good with improving interest. But we have to face the Class B, Class C office buildings. The discussion about switching them into resi, yes, might be a solution, but just for mini tiny piece, because technically it's just not possible. Yeah? But there might be some office locations that are not good office locations also for the next 20 years, but might be good resi positions. So that's something will happen, but that will only, I think, 2 or 3% of the market might be an option for. But the wider market, we really have to face the challenge in office and retail. We discussed already in the presentation.
Can I add something?
Yeah.
So, obviously, given the banking sort of stress situation and interest rate environment, there is obviously the headwinds for real estate are pretty strong, but we cannot forget that different asset classes are created differently. So they react to challenges and benefits in a different way. Therefore, also, like if we look at the megatrends, this is the same, applies to megatrends. Different asset classes react differently to megatrends. If we look at technology and logistics, I mean, this is what happened over the last 20 years. It completely shifted our behavior. So the demand for logistics rose rapidly. Then all the consequences of COVID or war in the Ukraine with transportation costs going up tenfold, or nearshoring aspect of after we redefine our supply chains, it's all speaking out for logistic. Data centers, another thing. I mean, absolutely the demand for data centers cannot be overstated. There was a research I read last week about the worldwide data. It's going to surge by 61% until 2025. So it's another huge demand for data centers. Urbanization as a next megatrend. I mean, there's a huge demand for units, for apartments. If you look at the demographic maps of big cities in the world, you will see, big dots getting bigger and bigger. So obviously, we need apartments, and I think the fundamental undersupply, that's actually a global thing. It's not only Germany. If you read the research, you will see the same aspects in the United States or elsewhere in the world. If we look at the offices, this is my personal view. I think office obviously do have some challenges because of remote working and because of ESG. But if we think way before COVID and we look at the capex as percentage to nominal net operating income, the percentage was growing over the years. It's been growing over the years. So the the office as an asset class was really getting less and less attractive, and this might work in a low interest rate environment, but if once the interest rates are going up, there is no cash left. And now we have fantastic good buildings. There's that people and tenants and renting them out, but we also have the old office stock that they will really have some challenges. So we'll see what 24 will tell us.
Maybe one thing that we haven't touched on that much. I think one of the areas also when we're looking what we're discussing, I think the complexity of real estate is not only the financing and the fundamentals. It's also about, if we take urbanization as one of the driving forces going forward, that it's less siloed sectoral-wise going forward than it was maybe over the last 10, 15 years. And that is the next level where we have to learn how to adapt to this different environment, that the buildings might be less of a pure office, a pure resi, pure retail, whatever. And that is possibly the other challenges. And this is something that the real estate world will possibly understand quite easily. But if you look at some of the investor world, they are regulated on quotas and things that doesn't make these kind of shift that easy as we think it possibly should be or it needs to be going forward. And maybe to add one thing on the funding gap side, for Germany, I think looking at that, a lot of the loans have a 10-year maturity. I think the issue is possibly, yes, there will be something coming on, but if you had a loan for 10 years, you should be able to compensate some kind of value decline if you managed it over the last 10 years in a proper way on that side.
I can only confirm that what we're talking about is the vintage 2021, 22. No, those when the yield compression was the biggest and the prices were the highest. Deals which we did 2018 on a 10-year tenor with a 2% interest rate, they still have 10 years, about now 5 years to go, and until then. You might have rent increases, you might have, with the indexation, certain ways to cover that. And the other thing, not only we as a bank, but I think the entire sector was very cautious after the last financial crisis, saying never over-leveraged. And we had a policy that the limiting factor was the debt yield at exit. And if you set that at a 6%, even in times when the interest rate was about 1 or 2%, sometimes we're called crazy why you ask for that high debt yield. But as you say, in fact, today we are there. And that means when a loan matures today, when we have an exit yield at 6%, we are still good covered for an extension.
Okay, good. I wanted to pick up a little bit on the sectors, and also maybe Philipp, from you, just update on any kind of any regulatory side, because obviously we hear about what's happening in terms of some of the residential side. So, is there any regulatory side that investors should be looking at, or that you think is going to influence the market, particularly over 2024?
I mean, it was already said that the ESG requirements will, of course, increase. They have already increased. So we have now the new Energy Performance of Buildings Directive coming from the European Union. So the talks, the so-called trilogue negotiations have been settled. So there's a plan on how it will come to the countries, the member states. And this will mean, so on the one side, the discussions on any enforcement of refurbishment is off, so no individual obligation, but there is an obligation by each member state to secure that energy savings by buildings is down to 16% in 2030, and then another 20% by 2035. Yeah, and then you have the requirement that new buildings need to be net zero by 2030, that for publicly owned building that is already required by 2028. And then again, there is, by different laws and acts, further requirements on energy saving, on your percentage of renewable energy you need to have. And so I think that these requirements coming from the regulatory side are really huge, with the aim of having the entire building stock net zero by 2050. So I don't know exactly what the number is, so maybe I have to ask the economist. I think the funding gap is fundamental, yeah? But I mean, of course, it's a challenge and it's an opportunity for many, but that's a very big thing. And then maybe just as a further issue on of course, on residential leases, I mean, we have already quite regulated market. The idea that we have demand that is clear, but I think we will not, from a political side, there is no willingness to allow for any kind of rent increase. So in the residential market, of course, that will cause further work from the regulator. But besides that, I would say, that's the main aspects.
Well, I think they can set benchmarks, and there's all theoretical. This is like with what they did in Dubai right now, or Abu Dhabi with the COP. It is all nice numbers, but to achieve that is way more difficult. And that we can get that stock by 2050, which we have here, and buildings will last over 100, 150, 200 years. To get that to a net zero from itself will not happen. You know, that money will not be there. So the challenge is not to get it to a non-efficient, but to get energy in, alternative energy to substitute the CO2 emissions.
Thomas, you were in Dubai for COP, so.
Yeah, it's. I understand fully that this is all challenging for the industry, as we are standing for 40% of CO2 emission, 50% of global waste, and I love these numbers, and we spend 90% of lifetime in buildings. So it's really relevant. And looking at the COP, it's not final results, but at least the world committed, that's the good news, to the 1.5 degree Paris. Paris target. Of course, there's still negotiations about fossil fuels and so how they can be compensated or used or not. But the good news is for the world at the end, they stick to 1.5 degree. If you look at IPCC reports, we all know that we are not on track on that. We are more on the 5-6 degree target. So there will be, and that's around the globe. I said Singapore taxonomy is linked to European taxonomy. Riyadh will come up. The World Exhibition, Riyadh Expo 2030. The Crown Prince committed to be net zero with this completely new developed thing. 6 million square meter to be developed at net zero, and that's a hard commitment he gave. So that's something where it will not move away, and we see global courts forcing the industry to move. Yeah, it's if now saying, and I know it's a real challenge from a capex perspective, etc., to do this transformation. But I think we are not yet on fire as other industries. If you look at automotive, we had a lady from BMW in our Paris conference, and she was explaining last year from Fraport, from aviation, how this political pressure. If you are really on spot, you are responsible now, you're the airline industry or the automotive industry, then you are really on fire. Real estate is still not politically on fire. So hopefully that's good, but it will change definitely. And I think we can't move fast enough. And I always hear the excuse, yeah, we don't know how. The solutions are there. We just have to use them. The technology solutions are there, of course, not 100%. I had a discussion with a concrete producer. He's producing net zero concrete, of course, to be challenged if that's really thin. But even if we have the CO2 impact of concrete, if you look at this dimension, just having been to Saudi last week again and to Dubai, ruining my personal CO2 footprint. But if you see what the cities, or there was a developer from Egypt, they created 15 mega cities in Egypt, and the plan is to build 20 more, and they are all working well. So that's a dimension. If you just look at concrete or steel, what the impact of this is, and that's something where we really have to think more bold, because there will definitely more pressure is coming. If we don't want, the regulator will do is all the global courts will push us. And there, I think most of the asset managers in Germany and around the world have some legal requests from some NGOs on the table saying you are not acting fast enough, you are not aligning with your commitment you gave as a company.
No, there's a big difference between those states who have who build cities in the desert and don't have anything else, but then to convert a century-long population and in the existing stock into that, and I doubt that will happen. So also the car industry, they're on focus. They produce these electric cars, and if everybody from us would buy an electric car, we don't have enough energy to run them. Yeah, so there's the big sectors that the converse. There's a lot lacking there. So putting more pressures on, produce less, insulate more, do this and that, well, is only one part of the thing. But where does the renewable energy come from? That is the big unsolved problem at the moment, and just pure solar and wind energy will not support.
It's just the pressure will increase. That's the key message. It will be challenging for all of us, and I know the discussion that we don't want to ruin the German and the European economy. It's all fair, but just saying, looking at all this, pressure will definitely increase also in real estate industry.
Yeah, the interesting thing was from the conference that I was at in Delhi, it's the World Investment Promotion Agencies. So it's all of those that are trying to attract inward direct investment into their cities, and they work very closely with the UN and with the World Economic Forum. And certainly a huge amount of the discussion, much more than I expected, was around sustainable development goals, the UN goals, how they're reaching those. And that included everybody from, the Polish cities all the way to Madagascar and Kenya and various, that was one of the key topics for them. So for sure, there's going to be that pressure building above from all areas, I think. Now, how achievable that is with existing ones like we have in the UK, where, the majority of the residential was actually built 100 years ago, if not longer. And so it's a sieve, really an energy sieve.
And listed.
Yeah, and listed, yes.
Perhaps one more comment to be a bit, we focus a lot of CO2 and greenhouse gas. Real estate also can have a positive, there are some low-hanging fruits also focus on biodiversity. And so where with some quick fixes, real estate can have on an ESG level a positive, or the social aspect is something where we don't have to turn around the whole building with significant capex. So there are other solutions or options coming up to have a balanced view on ESG. It's not just energy efficiency and embodied carbon, etc. So there, as I said, this biodiversity topics, having a social impact, it's sometimes not so difficult and not so expensive than rebuilding, renovating, completing the building. It's also part of the solution, but there are other options to have a balanced ESG view. So it makes it a bit easier, hopefully.
I have a question to Markus. So what is sort of your view, if you had a financing project, what are the requirements in terms of this whole ESG discussion? And is it easier to get a financing for like refurbishment of a house than a new project financing from scratch, greenfield?
Is it easier? No, but it is assessed in the same way. And when
nowadays, nothing is easy, I know.
we do that. We started this entire green shift back in 2015 when there was no regulation in place. We separated best performing assets and issued green bonds against them, green fund brief. So that is a way we already had implemented this entire structure. So, and then we have in our credit discussions, the ESG perspective is part of like how solvent is the tenant, how good is the building. Yeah? That is always part of the story. And if somebody comes saying, I'm going to buy this building, I extend the leases, I paint a bit, and then I'll flip it. And so, what if you don't flip it? What do you do with it? What is the consequence? How do you improve the emissions and these kind of things? And if there's no answer to that and no money to that, we don't do the deal. Yeah? So if it's a new build or a refurbished build, this is the same assessment.
Thank you.
Okay, good. I just wanted to pick up the sectors a little bit. And if anybody's got any questions, do shout them out, raise your hand, or or let me know somehow. A lot of discussion there about the office sector. So let's start with that, because that's a very big area. How do we feel about office in general? Are we more positive, less positive? Do we expect to see there, being a gradual change over a period? Are we expecting to see office Armageddon like you have in the States? What's our sense of that? Positive, not positive?
I think we are still sort of in the experimental phase. in terms of office. Obviously, the home, remote working. We still don't know. Are we going to work from home? Are we going to work from the office? What we see on the letting market is that the beautiful buildings, ESG conform, with a lot of amenities for the tenants in the perfect locations. The demand is there. I mean, the pace that floor was being let out was just enormous, and that just proves what people want. We also saw tenants from suburbs of Frankfurt, like Eschborn and all these locations that we don't want to work in, paying 15, 16 rents. They're moving to these beautiful towers and paying 40, 50 euros. They are very often listed companies because they need to fulfill the ESG criteria. So there's absolutely no other way for them to extend or, let a new building. So I think we can tick the box there. I think it's also a question of supply in our asset classes, right? So it's a question demand, supply. Okay, demand is a question mark because we still don't know the remote working, how is it going to look like going forward. But the supply, I mean, we see all this, cranes are actually not moving with all the insolvencies in the perfect locations that we read about, on the daily basis. There's not much stock coming up to the market. So what will be the impact of this situation in 2 years, in 3 years, right? And what's going to happen with old stock? How are we going to tackle the ESG? How are we going to tackle the attractiveness of the A locations and the old stock? And in the environment of high interest rates, so the capital cost is not as it used to be. So many questions, and I think at the end of 2024 we will know more.
I mean, when we speak to our clients, then we notice they are really afraid of office. So I think that for office will be very difficult here. Of course, as you said, Barbara, in a location, a top office, ESG compliant and beautiful, that of course has demand. So tenants want to move in. That is clear. But we see also many people and companies, they want to reduce their space because all of this issue with the home office is really like it came to stay. So all of the companies are now dealing with that they have 20 to 30% at least all vacancy, so they can give that away. And I think particularly in Frankfurt, we have a very huge market of subleasing, and this is still to come. So because, I mean, you have like lease agreements with 10, sometimes 15 years term, and all of these lease agreements, when they are renegotiated, they will, spaces will decrease. And before that, we have already subleasing. So what we have on product, which is yes, okay, but it can already be, I would say, served by the existing. So, and everyone which is around of that perfect area will really suffer.
Perhaps just one comment. I think we will not have a solution in 24. I think that's because all the dynamics are taking longer to really, and nobody really knows what the answer is. But I think what we are facing, it's going back to what do the people want. Yeah, it's about the experience. One is the individual and one is the corporate. So, and that's not the same direction. Sometimes the corporate wants to get the people back in the office, and the people say, well, if you push me, there are other nice companies out there, and then I will just move over. So, but the two fundamental trends, I think, which are pretty fair, people don't want to be 100% in the office. In average, we see different in Asia. It's different in Saudi. It's different. But now, speaking of the Western part, so people don't want to be 100%, but they also don't want to be 100% at home. I think that's for sure. And what can motivate people to go to the office? It's the experience. Yeah, it's in summer. Yes, it's an air condition now, and with heating up. That's one argument. It's about good food. It's about experience, but also looking wider. I think he had some comments on this. View on a city. People want vibrant cities. They want an environment where they can, in the office, have some experience, of course. That's the one trend, but also surrounding it. So recycling the city, looking here in Frankfurt at Niederrad. Nobody really wants to work there because there's nothing around. Perhaps I work close, it's easy. But in general, vibrant city where there are offices, resi, restaurants around. That are areas where people really want to go, and then they come back to the office. And then you go into the office, you have the experience about what does this office offer me. I think, and that's the journey where we will go. I think there's two direction, but it will take. We are invested in assets that are built for 50 years. Renovating such an office, transforming the concept is significantly expensive. So we are talking not just 100 euro per square meter, it's more 1,000 plus. Really transformation. It will take some years, but that I think at least the planks, it will be somewhere in the middle. Yeah, see, the office has a right to exist, that's for sure, but it will be a different concept. And a smaller number, again, Frankfurt is I think, worst example in Germany, as the office part is bigger than others, than Munich or other cities in Germany.
Did you want to pick that up, Markus?
Well, I can agree. I mean, what's good for environment, when we had the lockdowns, that nobody was traveling, and that was helping. And I don't think companies want people to help them, but managers want them. This is always a people's business, and depending how you want to run how you manage your people, you have an affection for this or that side. What is undisputed is that people don't live alone. They need contact, they need socializing, and that to find the balance there, that depends also on sector and how to work. When in a hospital you have to be there. There's no home office, but those office spaces here, which we have, people could accommodate to their needs. They don't need so much kita spaces or so much nannies and stuff. So once you have that quality, you don't want to give that back, and that is important for every employer to say, can I keep the work-life balance at that quality which is given at the moment, and this will drive that forward, and this will reduce, as I said, to less space needed, and maybe to also less new build, and gives maybe time to those who are then empty, might be refurbished, but those who own it at the moment will have to take the hit in the price.
And one of the things in Paris that came through very strongly was a much more positive story about retail, actually, both in terms of high street luxury, which may be just everybody positioning themselves in advance, but also shopping centres had been traded. And we're beginning to see in the UK as well shopping centres trading that you thought would never trade again almost. So could 2024 be the year of revival for retail? Does anybody have any? How is it here?
I don't think so, that there's a big revival there. But you just see that...
Start didn't sound encouraging there, Markus. Yeah.
No, how many insolvencies has Galeria Karstadt gone through, and still, why is that insolvent? Because people they want to have it in the city center, but they don't go there. They don't spend the money there. So that concept is not longer working. And these are big blocks in the high streets. So if you go along the Sigle, you have the Kaufhof and the Karstadt and the former Hertie, and then if those are vacated, the entire feeling is changing there, and they're not vacated because people go there. It's because people don't buy there. Yeah, so it's an intrinsic thing. It's self-motivated. So that if I can buy something online and Amazon delivers the next day, why shall I go in, walk there, search and run around and then carry it home? Yeah, so that sentiment has changed, and the pandemic has fastened that transition. And all city planners and mayors will have a big challenge how to keep the inner city and the prime pitch alive. And that maybe is different in Paris because they have a lot of tourists. People live in the city and have not so much of a commute. But as we are federalistic here in Germany, that is a bigger challenge than pure Paris. But look at the other cities in France. I think they're not so much better than we are.
I mentioned the megatrend aspect just a couple of minutes ago, and I think that we cannot forget this megatrend aspect. And we can actually answer this question by looking at our behavior. How do we shop? What do we do in our free time? Do we go to shopping center in order to spend some nice time, or do we rather stay on our sofa and buy everything via PATRIZIA or Outnet? So this is, so I'm very skeptical towards a shopping center or retail in general, but I've been skeptical since 2013-14 when I was actually dealing with a lot of retail space, and I've understood that actually, especially the German retailers haven't really understood the concept of e-commerce, and they are not really prepared for the whole, shift in our behavior in terms of in related to retail. So there's a lot of homework to do also there. That's why I'm not really positive on retail, especially shopping center in Germany. But for example, if you look at in Poland, it's a different cultural aspect. People love shopping centers. When Warsaw, I go there and I spend my time there, obviously shopping, because it's actually an experience. But it really depends.
Yeah, but that has to do that most of Polish cities don't have a high prime pitch in retail. This was a development, and there's a social meeting place. Is the shopping center there because it's modern, it's fashionable, and has the parking spaces and so that is completely different to where Germany or UK developed. They had the prime pitch as thing. They had the retail sectors in those cities, and then on top came the shopping centers competing. And Poland didn't have that competition.
Very true.
We are supporting a restructuring of a shopping center, which is expected that 150 to 200 million euro are spent in the repositioning. So I can tell you in maybe 2 or 3 years if that works out.
Okay, good. Well,
who is financing it?
Yeah, exactly.
Well, I think it was you, Thomas, who said heaven in 27. So maybe that will be the chance to be able to do that.
Survive till 25. There's going nix till 26 and be in heaven 27. I don't know if that's true, but just a comment on retail. I'm not an expert, but I feel that the sentiment is less negative than years ago, which is already positive. And we have done a study on the reuse of the old Kaufhof buildings. I think there were, 20 or 30 recycled, and the clear message was that all opening to a mixed-use concept are much stronger concepts, also in the context of creating vibrant cities again. So sticking to the pure play 100% retail never really worked out. But the transformation, yes, it costs a lot of money, and it comes with a, let's say, low entrance price, of course, but it happened in the past. So, and these concepts were stable afterward in the combination of retail, yes, but also other types of use in the same building. So at least that's what I can say.
Okay, good. And in terms of some of the other sectors, we mentioned a little bit logistics already. We mentioned a little bit about residential. But what about, you mentioned data centers as well a little bit. What are some of the trends telling us? We focus a little bit on senior living, obviously, senior living in healthcare, senior living, obviously, in terms of demographics here in Germany, should be an attractive asset class. But what else are we seeing here? Which ones, I suppose, do we think are going to be the winners and the losers if we look at the mega trends and where we are at the moment?
You're looking at me, Richard. Yeah, coming back to as I said, the fundamental trends is going back what people really want. I think it's about this logistics and its resi piece. I think that's the core topic where you also can invest significant amounts of money. Data center have developed a bit, I would say, comparing with other parts of the world where you have this data center REITs, etc. It's still evolving in Germany. So that's something, but we are facing the challenge on the energy prices, of course. Yeah, data center are highly energy efficient, consuming, and it's a question, how can we create an ESG compliant data center here in Germany? That's why a lot of data center moved up into Nordics, where you have a lot of green energy, which is possible, but we have to fight it. But it's not that you can invest multi-billion into a data center here in Germany. It's just a limited market, I would say. So I would go for that trend. And on the resi, I would see it on a broader space. I would say also managed resi, like student housing, micro apartments, elderly living. That's all part of this living story. I think that's a fundamental thing where we need more and more investment, and where a real need is, even now in a situation where construction costs are challenging. But I hope that it will come back to a balance in the midterm, definitely.
They move to the Nordics as data centers because there's not only green energy, but also they recycle the warmth, and they make the kind of heating pipes I think Denmark is running there, and they become maybe independent from fossil fuels because of this concept that wherever energy is emitted by data centers, waste, put it into good. And that is a very good example, a very big example of how this transformation can go. And this really, if you had a good article about it, that gives hope for the future going forward.
Something we could also do in Germany.
I mean, what we see is our clients are really like optimistic on logistics. So we see developments on logistics on a speculative basis without tenant, and they even got financing. So I would say logistics is doing quite well. So we are optimistic on that. And as you already said, data centers, it's a very small market, I think. In Germany, it will also be limited by lack of power. That is a question, and also by some regulatory issues. In particular, here in Frankfurt, we have some restrictions from planning and zoning law because the city of Frankfurt is not, let's say, so openly welcome further data centers in the city. So that is also a regulatory issue, which limiting data centers.
I would like to add again this, the aspects of demand and supply. If you look at logistic, I think it's a very, very strong asset from the demand side. From the supply side, I think we're going to get some headwind because of the scarcity of land that is still available on the market for this kind of assets. Also, the municipalities are getting sort of more and more reluctant to get the permits because obviously, if you have a logistic hub, then you don't really employ a lot of people there. It's the one aspect. The second aspect, supply on data centers, is it's a very capital-intensive asset class, and it's not everybody can allow 700 to 800 million of investments. In terms of senior living, Altenpflegenheim, I'm not quite sure what's the English word for that. It's obviously linked to politics, and we've experienced, 2022, 2023, what is the result of politics or bad politics on the asset class? I mean, it's really not existing anymore. So it's really tricky as an investor, not coming from the, senior living operation to bet on politics going forward. So that's a question mark there. From the demographic point of view, and this is something that I follow, you need to follow megatrends. It's an extremely important aspect that it's highly linked to the politics that I personally cannot follow anymore because it's complicated.
Okay, good. Interesting things around that, I think. We also did there's a bit more of a focus that we're beginning to see as well around the crossover with infrastructure. So especially when you've got then data centers, but you've also got people looking at towers, cell towers, a very big element in terms of the US, less so over here, but again, more of that change. And interestingly, I did an interview with the CFO of Euro Disney, and they have put in a data center in the city that they've built next to the park. And the data center there, the heat from that actually heats things like the public swimming pool and some of the office by it. So exactly what you were saying there in the Nordics is happening there in France for sure. So that was quite an interesting point. We're right up against time. So I'm just going to ask one more thing, which is just broadly, positive, negative, and also I remember with Rick Lewis from Tristan Capital 10 years ago or whatever it might have been, talking to him about the situation after the crisis, and his view was, well, that's dislocation in the market, and for me that's just a signal that it's time to get my rod and go fishing. So there's always a positive element for somebody in these areas. So I guess how do you feel about the market? Is it just survive until 25? Is it heaven in 27? Where are we? And also, I guess, where are the opportunities for those kinds of markets? And we'll particularly look as well at Germany here. Markus, any opportunities that you see?
Well, first of all, where are we? You usually have a 7-year cycle going up and going down. We had a long cycle over 10, 12 years only going up. So it will not vanish tomorrow. So can you be optimistic? Well, no, we can be realistic. Yeah? You know that we have to go some difficult years. This will bring some challenges, but also some opportunities. And that depends then really on how we tackle those big topics like the energy supply, like the transformation, and like the public transport, and deal with the organization there. It takes the time, but as now we are in that mode, we should maybe be forced to do the homework rather than do profit.
Yeah, we expect very much that clients focus on survive until 25, and in order to achieve that, I think during 24 they will still wait and see. No one will really go out now and make huge transactions, so mainly focusing on the own stock and asset management and maybe some restructuring cases.
I will quote again Charlie Munger, who just died, from Berkshire Hathaway. He said in his last annual meeting in Omaha, in order to stay happy, you just need to expect less. So I think this is the outlook 2024. I'm positive because that's pretty much my nature. I think I'm positive because we overcome the psychological sort of hurdle. People actually do expect that we have a problem and we have a crisis, and that's actually the first very important tick the box. And what's the opportunity for 2024? I think opportunities, dislocation and distress, because we're going to have and experience plenty of it.
Yeah, I agree. I'm not sure if 2024 will already be the year of the big recycling, but we will see some, as we already see on the development side, but also on the core funds, some assets that have to be divested. And I hear it from everyone, also from international investors, like Singapore REITs had a discussion 2 days ago. They said, yes, we are focusing now on Asia-Pac because we have to reshape our balance sheet and we will exit the other market, like Germany. And I think that comes with asset-relevant opportunities with the angle. I'm a value add personally. I'm a value add fan personally with the brown to green aspect, and the other aspect is as tech, prop tech is also part of the perimeter already. I see more and more good opportunities coming in the venture, in the prop tech space with good valuations currently. If you see that as part of real estate.
Thank you to all of the speakers. Thank you to everybody for being here, and CMS for hosting as well.